Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host, Desmond, and today we're diving into a concept you might have heard tossed around in the financial world, quarterly rebalancing. It sounds technical, but don't worry, I'm here to break it down for you. By the end of this short episode, you'll know what quarterly rebalancing is, who's doing it, and how it shakes things up in the markets. So let's get started. First up, what is quarterly rebalancing? Picture this, you got a portfolio, a mix of investments like stocks, bonds, maybe some gold or other commodities. Now, over time, those investments don't just sit still. Some go up, some go down, and pretty soon, your neat little mix isn't so neat anymore. Maybe stocks took off and now make up way more of your portfolio than you planned. Quarterly rebalancing is the process of hitting the reset button every 3 months, adjusting your holdings back to your original target allocation. For example, if you wanted 60% stocks and 40% bonds, but stocks jumped to 70%, you sell some stocks and buy bonds to get back to that 60-40 split, right? It's like pruning a garden to keep it growing the way you want. So who's doing this? Well, quarterly rebalancing is a big deal for asset managers, right? Think mutual funds, pension funds, endowments, and even some savvy individual investors, right? These are the folks managing billions, sometimes trillions of dollars. Take pension funds, for instance, right? They've got long-term goals, like making sure retirees get paid decades from now. They rebalance to stick to their strategy, keeping risk in check and ensuring they're not overly exposed to one type of asset. Right? Hedge funds might do it too, though some are more active and tweak things daily. Even index funds, which track benchmarks like the S&P 500, rebalance periodically to match their target index, right? Though that's not always quarterly. The why here is simple: discipline. Rebalancing forces you to sell high and buy low, locking in gains and avoiding the trap of chasing hot trends. Now, here's where it gets interesting. How does this affect the markets? When big players like these rebalance, they're not just moving pocket change. We're talking massive flows of money shifting between asset classes, stocks, bonds, commodities, even currencies. Let's say it's the end of March, right? And a bunch of funds need to trim their stock holdings after a big rally. They sell stocks, and that cash flows into bonds or maybe gold, right? That selling pressure can nudge stock prices down a bit, while bond prices might tick up from the buying. Commodities like oil or metals could see swings too, depending on where the money's headed. And currencies, if a fund in Europe rebalances by buying US bonds, they'll need dollars, so the dollar might strengthen against the euro. These moves don't always make headlines, but they ripple through the markets, right? Picture it like a giant game of musical chairs, right? Every quarter, the music stops and everyone scrambles to get back to their spots, right? It's not chaos though. It's predictable, right? Which is why traders and analysts watch rebalancing dates like hawks. For the average investor, it's a reminder. Markets aren't just about news or earnings. Sometimes it's these mechanical shifts driving the action. So to wrap it up, quarterly rebalancing is all about keeping a portfolio in line with its goals, done by big players like asset managers to manage risk and stay disciplined. And when they act, it sends waves through stocks, bonds, commodities, and currencies. Next time you hear about a weird market dip at the end of a quarter, you'll know. Rebalancing might just be at play. Thanks for tuning in, and in the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.